This voice is taken from an article with the title, "Can you explain the concept of currency correlation?" which has been published on TRADERTALKSNET. Currency correlation is an important concept in Forex trading. It is a measure of how well two pairs of currency pairs move in the same direction. It is a measure of how well two currency pairs are correlated in terms of their movements in the market. Currency correlation is a measure of the relationship between two currency pairs. The correlation is determined by the strength of the relationship between the two currencies and their movements in the Forex market. The correlation can range from -1, perfectly negatively correlated, to +1, perfectly positively correlated. When two currency pairs have a positive correlation, their movements in the market are in the same direction. That means when one currency pair rises, the other one is likely to rise as well. This is known as a positive correlation and is usually seen in pairs that are traditionally considered safe havens, such as the US dollar and the Japanese yen, or the euro and the Swiss franc. On the other hand, when two currency pairs have a negative correlation, their movements in the market are in opposite directions. That means when one currency pair rises, the other one is likely to fall. This is known as a negative correlation and is usually seen in pairs that are traditionally considered to be more volatile, such as the US dollar and the British pound, or the euro and the Australian dollar. Understanding the concept of currency correlations is important for Forex traders as it can help them better manage their risk. By knowing the correlation between different currency pairs, traders can better diversify their portfolios and manage their risk accordingly. For example, if a trader is trading the US dollar and the Japanese yen, they can look at the correlation between these two currency pairs to determine whether they should buy or sell. If the correlation between the two pairs is positive, then the trader knows that the US dollar is likely to increase in value if the Japanese yen does, and vice versa. On the other hand, if the correlation between the two currency pairs is negative, then the trader knows that the US dollar is likely to decrease in value if the Japanese yen does, and vice versa. Currency correlation can also be used to identify potential trading opportunities. If two currency pairs have a positive correlation, then the trader knows that buying both pairs at the same time might be a good idea. Similarly, if two currency pairs have a negative correlation, then the trader knows that selling both pairs at the same time might be a good idea. In conclusion, currency correlation is an important concept in Forex trading. It is a measure of how well two currency pairs are correlated in terms of their movements in the market. By understanding the concept of currency correlation, traders can better manage their risk and identify potential trading opportunities.